Staff at Goldman Sachs are braced to find out if they still have a job. The banking giant has begun a sweeping cost-cutting drive that could see its 49,000-strong workforce shrink in a big way. A Reuters source says just over 3,000 people will be let go. The cuts began in Asia on Wednesday. Jobs went there in wealth management and private banking. It wasn't clear how much upheaval was coming at Goldman's big hubs in London and New York.
Well, for Goldman, it's not exceptional. It's what an investment bank needs to do when you're facing a sustained period of market downturn. And the investment banking pipeline does not look to be improving as we look to the first quarter or even the first half of this year. So obviously you have to reduce your costs, and that mostly is related to people. There has been other announcements that includes Credit Suisse, Morgan Stanley, even Bank of America. They've been very modest cuts. And again, it really gets to, you don't want to get rid of great talent. And certainly you don't want to stop hiring new associates, because there is high turnover in investment banking, especially for the first 2 to 5 years. So keeping that in mind, what we're seeing here is maybe a better matching of lower revenue to needing lower costs. But I don't think this is a doomsday scenario, as we did see in 2008 through 2010, where banking just disappeared for a while.
The firm declined to comment on reports of job cuts. But Argus Research Director Stephen Bigger says banks have to bite the bullet after some tough quarters.
So most of the banks have held on to folks for the better part of 3 quarters here during the downturn. And I think what it really says also is that they don't expect the environment to improve very much in the coming quarters, or they wouldn't be jettisoning staff at this point.
The Financial Times says redundancy plans will be followed by a broader spending review, covering everything from corporate travel to expenses. Goldman is taking action after a massive slowdown in corporate deal-making. It's also been hit by a slump in capital markets activity since the conflict began in Ukraine. Among other measures, the lender is slashing its bonus payouts, with the total expected to drop by about 40%.